price shifting that's happening both in the new and used car market.
The American automotive market is experiencing a crisis due to the emergence of truly terrible cars that somehow continue to roll off.
If you buy a car this month, you're locking in one of the worst financial mistakes of the year. Prices are about to crash, and dealerships know it. They're rushing to offload bloated inventory while you still believe the sale banners. Walk in today, and you could be underwater on your loan before you reach the freeway. This isn't depreciation, it's a financial cliff. Why are dealers pushing panic sales? What's about to hit the market next month? And how do you avoid losing thousands before your second payment clears? Because by the time you realize the truth, it'll already be too late. Buy a car today, lose thousands tomorrow. Imagine paying $35,000 for a car that's worth $29,000 before you even get home. That's not a nightmare, it's reality for anyone signing a car loan right now. In a normal year, your new vehicle loses about 10 to 15% of its value the moment it leaves the lot. But this year is different. Buyers aren't just facing normal depreciation, they're walking straight into a financial cliff. What most people don't realize is that depreciation isn't linear. It accelerates under market pressure. When the value of the car drops faster than the balance of the loan, you become what lenders call underwater. That means you owe more than the car is worth. Normally, that takes a year or more to happen. But right now, you could be underwater the moment you drive away, locked into a multi-year payment plan for a rapidly sinking asset. Financing a vehicle today means locking in inflated values based on hype, not stability. Cars are depreciating faster than usual due to inflated sticker prices and shrinking buyer interest. And when prices drop next month, as dealers prepare to offload bloated inventory, anyone who bought in August will feel it instantly, not with a bang, but a $1,000 dip they can't undo. The danger isn't always hidden in the fine print. Sometimes it's standing across from you with a smile and a handshake. Dealers are playing you. Behind every limited-time deal and zero-down offer is a business model built on pressure, timing, and manipulation. Dealers aren't waiting for you to make a smart decision. They're trained to make you feel like hesitation equals failure. Right now, they're targeting fear, economic uncertainty, layoffs, interest rate noise, anything to make you think today is the best you'll ever get. Here's how they do it. First, they front-load offers with fake urgency. Only 3 left in stock, they'll say, even if there are 30. Then come the junk fees. Administrative costs, protection packages, doc fees, all buried in the final contract. By the time you're mentally committed, they've inflated the price by thousands, and you barely noticed. And because loan terms have stretched to 6 or even 7 years, most buyers never see the real cost until it's too late. Right now, dealers are offloading overvalued inventory onto unsuspecting customers. They know what's coming. They know price corrections are imminent, so they're disguising bloated prices with flashy rebates, hiding depreciation behind a bow on the hood. This isn't negotiation, it's entrapment. Behind the scenes, a different kind of manipulation is unfolding, one that starts with the banks and ends with a market-wide breakdown. If this is already hitting close to home, hit that like button so more people get warned. And drop a comment. Have you seen shady fees or fake discounts lately? Your story might help someone avoid a massive mistake. The more we talk about this, the harder it is for dealers to keep hiding the truth. Rate cuts are a trap. On the surface, a rate cut sounds like good news. Lower interest, more affordability, right? But what if that optimism is the very thing making the crash worse? That's what economists are warning behind closed doors. Rate cuts create a temporary sugar high, a rush of buyers trying to lock in low financing before it disappears. What most buyers don't realize is that rate cuts don't just lower payments, they also manipulate perception. It makes people think the worst is over, that now is safe to buy. But in reality, that confidence fuels a premature buying spree. It creates demand that shouldn't exist yet, and when that surge ends, it leaves a vacuum. That's what we're seeing now. In the spring and early summer, buyers flooded showrooms expecting high prices to last forever. But that wasn't organic demand. It was pulled forward from the future. People who would have waited until fall or even next year bought early, creating an artificial spike. And now that wave has crested. With fewer buyers left and dealers still holding overpriced stock, the bottom is set to fall out. Worse, those who rushed in didn't just buy high. They bought fast. Many ignored warnings, skipped research, or waived financing protections in exchange for discounts that will mean nothing once next month's price correction hits. A rate cut didn't create relief. It triggered a collapse in slow motion. Meanwhile, across the ocean, a massive economic signal just dropped, and it's already shaking the foundation of everything you thought was stable. China slams the brakes. Last week, Beijing issued an unprecedented order. Chinese electric vehicle manufacturers must stop slashing prices. The government itself stepped in, not to protect profits, but to stop economic damage. In their words, the EV price war had become involution, a self-destructive race to the bottom. That's not just a signal of corporate chaos, it's a global warning. For over a year, China's EV makers, Build Your Dreams, NIO, XPeng, have been flooding the market with cheap, aggressively discounted electric vehicles. That strategy worked in the short term, but the ripple effects are now visible. Profits collapsed, inventories piled up, and international rivals couldn't compete. Now, the government fears that continued price cutting could destabilize supply chains, kill smaller companies, and trigger regional recession. But this isn't just China's problem. American and European automakers are directly affected. Many rely on Chinese suppliers for batteries, parts, and production partnerships. When China says stop, the global supply chain listens. And if the world's largest EV market is slamming the brakes, what does that say about demand? It says one thing: the price crash isn't coming, it's already begun. What happens next will hit consumers first and hardest. Zooming in from the global stage, the fallout begins with one buyer and a financial nightmare the buyer who got crushed. Mason thought he was doing everything right. 26 years old, just landed a steady job, finally cleared enough to qualify for financing on a modest SUV. He walked into the dealership excited, confident, and maybe a little proud. He walked out with a 6-year loan and a brand new vehicle parked in his apartment lot. For a week, he felt like he had arrived. But then the phone calls started. A friend texted him a screenshot, his exact vehicle, same trim, same color, now listed for $3,000 less on the same dealer's website. Then, a week later, it dropped another $900. Mason had barely made his first payment before his car was worth less than what he owed. Not slightly less, significantly. Overnight, his moment of pride became a pit in his stomach. Now he's stuck. If he sells, he eats thousands in losses. If he keeps it, the value keeps dropping. Mason isn't some reckless spender, he's the average buyer. He just didn't know the crash was coming, and the dealer didn't tell him. They never do. But this isn't just a buyer's burden. It's now echoing through factories, towns, and lunch tables, where uncertainty is growing louder by the day. Workers feel the collapse coming. You can feel it in the parking lots. The second shift at the parts supplier in Indiana was cut 2 weeks ago. Last Friday, management at the stamping plant in Ohio told workers they should take advantage of overtime while it's still available. The factories haven't gone quiet yet, but the hum of production is slowing, and the workers know why. When car sales stall, production pauses. When production pauses, jobs vanish. And in small towns where auto manufacturing still props up the economy, that kind of slowdown spreads like fire. The brake pad line goes idle, the paint shop loses hours, and soon suppliers start cutting jobs in clusters. Some employees have started taking photos of empty shipping bays. Others are texting co-workers late at night, trading rumors about early closures or shutdowns. Even supervisors are quieter than usual, offering vague encouragement instead of real answers. You can feel it. The optimism is gone. In its place is quiet, shared dread. Workers see it before the press does, through thinner paychecks, half-stocked vending machines, and fewer trucks pulling up to loading docks. Some are taking side gigs early. Others are praying their plant isn't next. Most are watching social media and news reports, quietly panicking as inventories swell and new car lots stay full. They've been through this before. 2008 taught them what a collapse feels like. It starts with whispers, then the pink slips come. Policymakers aren't staying quiet, but their loudest moves may be the most reckless ones yet. Tariffs are backfiring hard. On paper, tariffs sound tough. A bold economic shield to protect domestic jobs and punish foreign undercutting. But in reality, tariffs are almost always a mask, designed to hide structural weakness. And right now, both the United States and the European Union are pulling that mask tight. In the last 60 days, new tariff proposals have been floated across Washington and Brussels, targeting Chinese electric vehicles, Korean battery imports, and even European sub-assemblies. The justification? Protect local automakers. The real motive? Panic. Tariffs don't fix consumer demand. They don't reduce overproduction. All they do is raise prices, slow trade, and make vehicles more expensive for the people who can least afford them. What's worse is the timing. These new policies are rolling out just as inventories are swelling and consumer credit is tightening. In short, automakers are trying to sell more cars into a shrinking market, while politicians are making those cars cost more. That's not policy, it's self-sabotage. The public won't feel it at first. Tariffs take time to trickle down, but by autumn, sticker prices will inch higher, not because the cars got better, but because the systems around them are failing. While tariffs dominate headlines, the quiet collapse is happening closer to home. in your own neighborhood driveway. Used cars are crashing at home. Last year, Mike and Jenna bought a 2-year-old crossover, reliable, great mileage, roomy enough for the kids. It cost them $27,000, which felt fair at the time. They financed it with a 5-year loan, but 2 weeks ago, Jenna noticed something odd. A dealership ad online showing the same car, same mileage, listed for just over $20,000. She laughed at first, assuming it was a stripped-down version, but it wasn't. They called the dealership. The manager admitted prices were softening. When they checked their loan balance, they realized they were nearly $5,000 underwater. It happened so fast, they didn't see it coming. And they're not alone. In neighborhoods across the country, used car values are falling like dominoes. Tesla trade-ins are being rejected outright. Trucks are sitting on resale lots longer than ever. What's worse, people who bought used vehicles during the shortage years, 2021 through 23, are now finding their cars worth 10 to 15% less than what they owe. No one warned them this would happen. No one told them the used market could crash just as fast as the new one, but it has. And it's starting not in headlines, but in driveways. Pull back the curtain, and you'll see the real beast behind the curtain. Millions of unsold vehicles rotting in silence. 3 million cars, no buyers. Somewhere right now on a sun-blasted shipping yard or behind a dark warehouse door, there's a brand new car with plastic still on the seats. And no buyer in sight, not one. Multiply that by 3 million. That's the current estimated overstock sitting across global supply chains. From North America to Europe to Southeast Asia. New cars built, transported, and parked, with no demand left to absorb them. This isn't just bad luck or poor forecasting. It's systemic failure. Manufacturers ramped up production during the post-pandemic supply shortage, convinced the demand would last. But the buyers didn't follow. They were tapped out. Credit was tightening. Interest rates were climbing. And when the banks hesitated, so did consumers. Now, dealerships are overloaded. Ports are clogged. Automakers are bleeding money just to store the vehicles they can't move. In past cycles, these companies would slow production to rebalance the market. But that doesn't work anymore. Not at this scale. The machines have already built the backlog. The cost of halting now is almost as high as the cost of waiting. And the longer they wait, the more the value of that inventory collapses. Every day, those cars sit. They lose money. In a last-ditch effort to clear the pileup, automakers are turning to the oldest trick in the book. But this one comes with venom in the fine print. Incentives are bait. Cashback, loyalty bonus, 0% APR. These aren't just promotions. They're warning signs. When automakers start offering big incentives, it usually means something is deeply wrong behind the curtain. The cars aren't moving. The numbers aren't adding up. So they reach for the oldest trick in the book. Bribe the buyer, but incentives don't change the fundamentals. They just delay the pain. The moment an automaker hands out $5,000 in rebates to sell a car today, they set a new price ceiling for that model tomorrow. Buyers who paid full price last month feel cheated. Buyers next month expect an even deeper discount. This tactic backfires quickly. One customer posts their deal online, and suddenly every future buyer expects the same discount, or better. It creates a race downward. Sales teams scramble to match unrealistic expectations, and manufacturers lose control of pricing entirely. What starts as generosity turns into chaos within weeks. And just like that, the entire pricing structure begins to unravel. What's worse is how incentives distort buyer behavior. People who weren't planning to buy get pulled in by a flashy number, only to discover they've bought into a depreciating asset. The rebate becomes the rope around their financial future. And once the discounts stop, the demand evaporates again, leaving automakers in a deeper hole than before. Incentives are not solutions. They're symptoms. They're the sugar rush before the crash. And this time, the crash has a date. Circle a date on the calendar, because what's disguised as a deal window is actually something far more dangerous for millions of buyers. August will ruin you. Every year, late August arrives with its usual marketing circus. New model year clearance events, back-to-school sales, best deals of the year. It's a trusted seasonal rhythm, and buyers have been trained to believe it. August is when smart people buy cars. But this year, it's the perfect trap. Because behind the banners and balloons is a dealer network desperate to offload overvalued stock before the correction lands. Manufacturers are sitting on massive inventories, and they're flooding the market with discounts. Not because they want to, but because they have to. That desperation isn't a deal, it's a warning. Buyers think they're timing the market smartly, just like last year or the year before. But this August isn't seasonal, it's strategic. Dealers are using tradition as camouflage, relying on your habits to push stale inventory. It's not a clearance, it's a setup. disguised with balloons and a price tag that's already out of date. Here's what makes it worse. Many buyers are holding out for those August savings, not realizing that September will bring a very different story. Not just cheaper cars, but cheaper financing, smaller inventories, and lower demand. If they wait, they win. If they buy now, they lose thousands before the paperwork finishes printing. This August is not a window of opportunity. It's a last-ditch effort by an industry trying to reset the clock before the bottom falls out. But the timing can't be stopped. And for those who bite, regret will settle in before the engine even cools. Beneath the surface, the truth has already started leaking, from wholesale auctions and financing desks that see the crash before the public does. The silent crash is already here. The collapse isn't loud. There are no headlines screaming panic. No emergency briefings on CNBC, but week after week, the numbers are dropping. The used car market is quietly bleeding value. And it's happening faster than analysts predicted. Over the past 12 weeks, wholesale auction prices have fallen every single week. That hasn't happened in nearly 4 years. Dealers are paying less for inventory because they expect to sell for less. Lenders are adjusting loan terms because resale values are deteriorating. And large institutional players, auto-backed securities, leasing firms, fleet resellers, are starting to get nervous. This isn't a seasonal dip, it's a realignment. The average used vehicle now sells for nearly 8% less than it did in the spring. Electric vehicles, once protected by scarcity, have dropped even faster. Tesla's used prices are down over 10% in some markets. Hybrids and compact SUVs are next. And because this is all happening at the wholesale level, consumers won't fully realize what's coming until their trade-in value collapses, or their auto loan gets denied. By the time most drivers figure it out, the window to react will have closed. Because once depreciation speeds up, it doesn't stop, it compounds. The warning lights are flashing, and behind boardroom doors, carmakers are already slamming the brakes. Carmakers are retreating fast. In executive boardrooms from Detroit to Stuttgart, panic is no longer a quiet whisper. It's official strategy. Car companies that once bragged about quarterly growth are now slashing production lines, cutting model offerings, and lowering revenue guidance for the rest of the year. They aren't just bracing for a slowdown, they are planning for collapse. Stellantis has announced sweeping cost reductions, including the cancellation of several low-margin vehicles. Mercedes-Benz warned investors of a significant revenue drop due to tariffs and softening demand. Even Toyota, long the image of conservative strength, has paused key expansions and is quietly reassessing its global EV rollout schedule. These are not adjustments, they're retreats. Layoffs are happening, but not the kind you see on the factory floor. These are corporate restructurings, international team reductions, and strategic efficiency realignments. Carmakers are shrinking from the top down, trying to preserve cash and appease shareholders before the next earnings call triggers a sell-off. They know something retail buyers don't. The demand cliff isn't coming. It's here. This is what it looks like when an industry loses confidence in its own future. The language may be polished, but the decisions are pure survival. And the next wave of consequences? You'll feel it directly, in your wallet. Executives aren't the only ones reacting. In DC and Brussels, the panic is spilling into policies that could cost you more than any car ever could. You're paying for their panic. Governments don't like losing face. When industries collapse, elected officials scramble to look tough, look active, or look like they still matter. That's why we're now seeing a patchwork of panic policies being rushed out in parliaments and congresses worldwide. None of them help you. All of them cost you. In the United States, tax credit expansions are being quietly folded into inflation legislation, an effort to disguise subsidies as consumer relief. But those credits get eaten up instantly in sticker markups, adding no real savings. In the European Union, proposals for EV price caps are circulating, which will only throttle supply further and trigger higher prices across the board. And in China, the government is injecting capital into state-aligned EV firms to keep them afloat. Not because they're healthy, but because letting them fail would expose just how bad things are. These are not solutions. They are economic smoke bombs. Every bailout, every tariff, every forced subsidy gets paid for, either through higher taxes or through hidden inflation that erodes your purchasing power. The market is sick, and instead of treating the root cause, governments are numbing the pain with your money. Far above the headlines, capital is already shifting. Quietly, ruthlessly, and with full intent to profit from the collapse below. Wall Street is betting on collapse. Wall Street doesn't wait for permission. Neither does Frankfurt, London, or Shanghai. By the time the public hears about a downturn, institutional investors have already placed their bets. And right now, those bets are brutal. Hedge funds are quietly shorting legacy automakers and cutting positions in EV startups. Sovereign wealth funds are reallocating exposure from car manufacturing to lithium mining, betting that minerals, not vehicles, will hold long-term value. Even credit agencies are beginning to issue quiet downgrades of auto loan-backed securities, citing rising default risk and falling collateral values. That's a cold calculation. If used car prices collapse, auto loans become toxic. The financial world doesn't care about sentiment. It reads numbers, it tracks inventory, it anticipates patterns. And right now, those patterns point to a deep and prolonged contraction in both new and used vehicle markets. The institutions have already exited the showroom. They're watching the wreckage from a distance, liquid, hedged, and largely protected. You don't have that luxury, but you do still have time. You can still choose not to follow the herd into a fire sale, because while most buyers are walking blindfolded toward the cliff, others are quietly stepping back. So what can you do while the giants clash and the markets crack? Turns out, the smartest buyers are already moving differently. If you've made it this far, you're clearly not someone who falls for the trap. Subscribe now, because what's coming next month will be even bigger, and you'll want the facts before the headlines hit. This isn't just about saving money. It's about seeing what they don't want you to see before it's too late. What smart buyers do now. The smartest people in the room aren't buying a car this month. They're waiting. They're leasing short-term. They're repairing what they already own. And they're watching the market, not reacting to it. Because the best deal in a crash isn't the one advertised today. It's the one that appears after everyone else panics. For some, that means holding off entirely until early next year, when the backlog finally breaks and prices stabilize near the bottom. For others, it means looking at alternative options, subscription-based mobility services, flexible leasing plans, or certified used cars from corporate fleets that will soon flood the market. And for those who absolutely need a vehicle now, it means negotiating with the awareness that time is on your side. Dealers know what's coming. You don't need to rush. Smart buyers are also preparing financially. They're improving credit, saving cash, and keeping loan terms short and manageable. They're avoiding 6 or 7 year loans like the plague. They know that a shiny rebate today means nothing if their car loses $5,000 in equity next month. This isn't about fear, it's about leverage. When markets panic, those who stay calm win. You've seen the setup, you've seen the consequences. The question now is, will you act while there's still time? They want you uninformed, rushed, regretful. But now you know better, so don't stop here. Subscribe, stay ahead, and make your next move on your terms, not theirs. This crash isn't coming, it's already begun, and by next month, it'll be too late to undo the damage. Be early, be ready, and never buy blind again.